welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canada added more jobs than expected last month. Data from StatsCan shows the labor force added nearly 88,000 jobs in May. That's well above the 10,000 that economists were expecting. The agency says the gains were fueled by full-time jobs, with construction leading the overall results. Meanwhile, the unemployment rate fell to 6.6%. That's the lowest level since January. Bloomberg is reporting Canada, the U.S., and Mexico will not meet the CUSMA renewal deadline of July 1st. Part of the agreement includes extending the deal for 16 years. If the countries don't agree to renew the deal, CUSMA remains in place until at least 2036 and will enter rolling annual reviews. According to this latest report, by rejecting the formal review, the Trump administration will trigger negotiations and an indefinite period of uncertainty about the agreement. Shares of Lululemon are trading sharply lower today after the maker of yoga wear cut its profit and sales forecast for the full year. Lululemon says its performance is being affected by negative commentary in the media and online about its brand. It also says not all product launches have met expectations. And we're keeping an eye on the TSX today. It is down by almost 2% at this point, losing a lot of the points that it made up yesterday. Healthcare consumer staples are helping to boost the TSX up, but materials really dragging that index down today. And if we take a look at U.S. markets, it is a similar story there, all in the red. The NASDAQ in particular down almost 3% right now. Job reports are adding to the speculation that the Fed's next interest rate move will be a hike after seeing relatively strong job numbers today for both the U.S. and Canada. That seems to be affecting investors. Coming up, to economists' surprise, Canada added nearly 90,000 jobs in May, blowing past expectations. We've got more on that when we return. Stay with us. Canada added almost 90,000 jobs in May, blowing past economists' expectations and bringing the jobless rate down to 6.6%. Still, May's job growth only partially reverses the loss of 112,000 jobs in the first 4 months of the year. And we got more from Veronica Clark, economist at Citi.
The most important thing to remember is that this is just incredibly volatile data. So yeah, you don't want to read so much into any 1 month. But yeah, this was much stronger than we expected. We did see it in full-time employment, which is usually a better indicator of the more stable employment, which is a good sign. But full-time employment and total employment, both of those in level terms are just back to where we were at the beginning of the year. We had a number of much weaker months. The unemployment rate is still in this 6.5% to 7% range that it's been in for a while. So I would really caution reading too much into just this 1 month of data.
I take your point on that, but we'll still look into it as well and just see where we got the jobs numbers from this month. Like, which sectors saw the most strength?
Yeah, it was relatively broad based. It was both goods and services. So maybe there is some recovery in goods, material related sectors. We did see some strength in sectors like food services and accommodation. Of course, at the same time, we also had a really strong employment number in the U.S. I do wonder if maybe there's some early summer hiring. Both countries are experiencing World Cup related demand. Maybe something like that could support sectors like food services, accommodations. So we'll see how the data evolve into the summer, but maybe there's some early summer hiring going on.
Yeah, and then on the flip side, where did we see the most weakness in terms of sectors?
Yeah, I mean, definitely like some of the more trade exposed sectors, you're getting some recovery, but there's still a ways off from where they were, before all the trade uncertainty and developments. So, manufacturing, that's, softer than probably you want it to be. But we do see more recovery there, as those trade uncertainties maybe do start to fade.
When it comes to regions of Canada, it's always interesting to break that down as well. Like, which provinces or territories saw the most gains in the month of May?
Yeah. Ontario, of course, a large province that's had a couple of months now of employment gains. British Columbia did also. Again, maybe the strength in sectors like or in regions like Ontario, maybe that is reflecting some kind of recovery from trade developments. But again, it's just a couple months that we've seen gains there, so you do want to take it with some caution.
Yeah, as you say, like this could be some hiring for the World Cup, especially if you're saying we saw most of those gains in Ontario and BC, which is where they're going to be hosted. Okay, so this report also did have some good news for young people in it, though, with the jobless rate falling almost a full percentage point. Is that what you're saying maybe we shouldn't be reading into, or what did we see there?
Yeah, I would be a little bit cautious on that still for now. It is a positive sign for hiring. If youth unemployment is coming down, that's a cohort that has really struggled to find work. This has been a very low hiring, low firing environment for a while, but that really does weigh on new entrants to the labor force who are looking for jobs for the first time. But yeah, I would caution that this is May data. It's early in the summer. As we get more students after the end of the school year starting to look for work. There has not necessarily been a broad-based recovery in hiring demand. I watch data like Indeed.com job postings, so new postings for work, and those have started to come down at the end of May. So I'm still a bit cautious that we'll see a sustained recovery there, but it would be a positive sign for new hiring if we did.
I want to talk about the unemployment rate as well and how these gains in jobs maybe impacted the unemployment rate. What have you seen there?
Yeah, I mean, certainly they're related. Of course, we added a lot of jobs, and the unemployment rate came down. We've been stuck in this 6.5% to 7% range for the unemployment rate for a while. We got a little bit above that range, end of last summer or so. But that kind of range, it is higher than what we saw pre-pandemic. It does, it is telling us that the labor market is looser than pre-pandemic. You would probably want to see more sustained pickup in hiring to get that unemployment rate lower. The way the Bank of Canada would be looking at it, that is still an unemployment rate that is correlated with a negative output gap. We're still running activity below potential. But yeah, so we've just been stuck there. If we saw more months like this month, of course, more job gains like this month, I would expect that rate to come down. But it does seem pretty stable in this range that it's been in.
We've seen GDP data showing the Canadian economy contracted slightly in the last 2 quarters. Despite that, many economists have yet to say we're actually in a recession. I wonder, how do these job numbers that we're seeing today kind of play into that debate, do you think?
Yeah, if anything, it does make you a bit more comfortable with the state of the economy after Q1. We had that Q1 contraction in GDP. It looks like Q2 activity will rebound. We had the flash estimate for April GDP showing 0.4% growth. That's a pretty strong month. Maybe May will also be somewhat strong. So we should expect some recovery in growth as we get into Q2. But it is tricky again because we've just seen such extreme volatility in the growth figures and the employment data. So you do have to average through many months and many quarters, and it still seems like the labor market is weaker than you want it to be. The unemployment rate is stuck in that 6.5% to 7% range, and growth is not quite as strong as potential, not quite as strong as the Bank of Canada would maybe want it to be.
That was Veronica Clark, economist at Citi. Well, we're seeing a dip in tech stocks today, coming off a rally for AI stocks and speculation of a Fed hike from the latest U.S. job report. Here to make sense of this dip and more is Rebecca Telcher, portfolio manager at New Haven Asset Management. It's great to have you join us. Thanks so much.
Thanks for having me.
So yeah, we're seeing most of the North American markets in the red today. The NASDAQ in particular sinking quite a bit, like 3% at the moment. What do you make of what's driving the markets today, particularly that dip we're seeing in the NASDAQ?
Yeah, it's been a while since we've had that good news is bad news scenario in the market. And I think that's exactly what we're seeing today. Like the initial print was really strong. And so, it's signaling a stronger economy, higher than expected job numbers. And so you would expect, it's funny because even Donald Trump just tweeted it a few hours ago saying the market should be up today because that's what you would think when there's a positive post. But what ended up happening is, and we saw this a lot towards the end of last year when expectations for a rate cut were very strong, but we're seeing it again today that stronger employment is going to translate to, stronger consumer spending, potentially stronger inflation, and especially with oil prices is, above $90, that's going to attract a stronger inflation. Stronger inflation means the Fed's inability to be able to cut rates down the road, which I'm kind of surprised to see today, because I would have expected that expectations for, rate cuts are pretty low, considering we've seen that move in energy prices. But that being said, it seems to be what's driving the market down today. You could see that because all the markets are down, and, the U.S. 10-year is up, 1.5%. That being said, I mean, this tech rally is long overdue for a little bit of a pullback. Yesterday's Broadcom numbers, the expectations for have come down with regards to strong growth quarter after quarter, and so I'm not surprised to see that it's the tech sector that's taking the brunt of the hit today.
I want to move on and talk about Lululemon as well, because obviously we're seeing results for Lululemon. Investors kind of punishing that stock today despite the results we saw. What are your thoughts, first of all, your key takeaways from what you heard from Lululemon after this latest earnings results come out?
Yeah, I mean, so it's not a name I follow closely. We don't own it. I mean, we don't own one. I'm always hesitant on any kind of, fashion brand, just because, fashion can be popular 1 minute and then not the next. As long-term investors, we want to be able to invest through long-term cycles, not just, what's in trend right now. And then the second also, discretionary stocks are just not what we focus on. Again, we prefer defensive, focusing on client needs, not wants. And discretionary spending is exactly when you do see, a sign of a recession or consumers, being strapped for cash. The first place they usually stop spending are these discretionary items, whether it's going to be, a car or $100 pair of pants. So we wouldn't own that in general. But I have some thoughts on Lululemon and what specifically happened. I mean, this was, the definition of a pandemic darling. Everyone's working from home. No one needs suits. Everyone wants loungewear. And so at the time, there wasn't that, they had a real niche in the market. There wasn't that many competitors available to them. And so they, definitely profited off of that. And it was really a pandemic darling. In the past 5 years, we've seen a lot of things change. I mean, we've seen some, shift in terms of the management, and we're seeing a battle now between the board and the ex-CEO. We're also seeing a shift in consumers. I mean, now there's more competitors in the space, like Alo, is taking a lot of market share from Lululemon. And thirdly, and most importantly, I think, is that over the past 5 years or even longer, there's been, a shift, towards lower quality to increase margins, which works out really well in the short term, but over the long term can be very detrimental to a brand. So I'm not surprised to see that the stock is, it was down 12%, now it's down 9%, but, even over a longer term, the stock has really suffered over the past 5 years. I don't know where it bottoms out. Again, depends on where the economy goes, but a lot of their competitive advantages have now have been reduced over time.
Okay, and I also wanted to ask you about the SpaceX IPO, topic of conversation right now quite often. You say, because obviously it's a $135 IPO price, $1.7 trillion valuation. You say this is astronomical, the price of this, in your view. So tell me more about your thoughts on SpaceX listing potentially later this month.
You know what? I don't even have that much thoughts on it. I mean, my thoughts on SpaceX are my thoughts on, the AI space in general. There's going to be winners and losers. But I think, buying anything at astronomical valuations won't make sense in the short term or the long term. Think about it. Microsoft, if you invested in Microsoft in 1999, it would have taken you over 20 years to make your money back. So you could be a really good company, but a really bad stock if you're trading at, a bad or too high of a valuation. And that's how I feel about most of the tech stocks right now, whether it's Nvidia, whether it's these new IPOs, OpenAI, SpaceX. I mean, nothing should be trading at 200 times. Today there was a news that, S&P is not going to include it in the S&P 500, despite that it's going to have, over $1 trillion valuation. I mean, that makes sense. You need to establish a one-year track record of liquidity and profitability. I think we're getting into, a little bit of lunacy when it comes to some of the valuations of these tech stocks. I don't want to say it feels like, the 90s internet boom, because again, internet is here to stay, but a lot of those companies and those valuations weren't. So I don't want to make that comparison, but I do see some similarities. We've definitely stayed away from that entire sector, for better or for worse. On some days it doesn't feel, great to, but we've just held true with our conviction and not buying, the frenzy. The other thing that worries me about the SpaceX IPO is that retail investors may, bear the brunt of the loss if this goes badly. I think it's 20 to 30% is going to be available to retail investors, which is pretty unheard of for an IPO. And it just makes me think that, retail investors are usually the ones that get in late, that chase that market all the way up to the end, and they're the ones that lose the most. And I think they're the ones that most at risk. And it makes me really sad, because they're the ones that, are saving for their retirement and are often investing all of their savings, right. And they're at the highest risk. For many years, we've seen tech companies trade at valuations that only go up, and, that can't last forever.
Okay, we're going to have to leave it there. We're out of time. But Rebecca Telcher, portfolio manager at New Haven Asset Management, always appreciate getting your thoughts. Thanks so much.
Thank you so much.
Coming up, we will bring you some of our conversation with Pierre Poilievre, the leader of the official opposition of Canada. Stay with us for more on that. Welcome back. BNN Bloomberg's Marilla Fernandez sat down with Pierre Poilievre, leader of the official opposition of Canada, in a wide-ranging interview and discussed the Canadian economy, trade, and recent polling. Take a listen.
Well, I think it's a grand illusion that Mark Carney is doing anything. Look, he's given us the only recession in the G20. So there's 19 other countries in the G20. That's the group of industrialized nations. 19 of them are not in recession. Only one is. And that's Canada under Mark Carney. He's given us 2 consecutive quarters of shrinking GDP, 5 consecutive quarters of falling investment. A net $20 billion has fled the country in business investment since he took office. We have the second highest unemployment in the G7. 120,000 jobs have been lost in the first 3 months of this year alone. So I think there's a great illusion, a legend, that is going to collide with the reality that here we have Mark Carney continuing with all the same policies of the last 10 years of Liberal government, and ultimately things are not getting better, they're getting much worse. So it's going to take some time for the illusion of Mark Carney to collide with the reality, but it will happen, and ultimately we will be there providing a positive alternative that Canadians can rely on to make Canada affordable, safe, and secure here at home.
Okay, so you think Canadians are buying into a storyline that will end. I also want to get you on this. What do you think about the senior deputy governor of the Bank of Canada warning about overreacting to the word recession?
Well, I noticed she said that we shouldn't rely just on one measure for recession. I agree. Let's not rely just on the fact that unfortunately 2 consecutive negative quarters of GDP have happened. I have here the rest of the data. 112,000 jobs have been lost in just the first 3 months of the year. We have the second highest unemployment. The economy has shrunk in 3 of 4 of the quarters that Mark Carney has been in office. Business investment fell 0.7% in the most recent quarter, the 5th consecutive quarter of decline. Over $20 billion of net investment has fled the country. Unfortunately, Equifax has reported that mortgage defaults are up by 32% year over year to a 2-decade high. So if the Bank of Canada does not want us to rely on just one data point, 2 shrinking quarters of GDP growth, that's fine. I'm all right with that. Let's look at the other data. Unfortunately, it's even worse. And by every measure, Mark Carney has given us the only recession in the G20, and it's time to reverse the Liberal policies that got us into this mess.
Let's get to something else that has been weighing on the economy, of course, which are tariffs. The Kuzma review is coming up. You've talked about using leverage for the country. You mentioned it a couple of minutes ago, talking about the energy need for data center build out. We can use that as leverage, for example. What other leverage would you use in those conversations?
Well, I think we should use the fact that we have 10 of the 12 NATO-defined strategic minerals in our grasp. We have, for example, the only 2 cobalt refining facilities in all of North America. You can't make an F-35 jet without cobalt. In fact, we produce enough cobalt at our refineries for 75,000, that's 1,000, F-35 jets. We have the germanium for night vision technology, the gallium for radar and semiconductors. We have the aluminum that is necessary for fighter jets. The list goes on and on. What I've proposed is that we offer to tailor a strategic reserve of those minerals so that the Americans would know that they could buy them at market rates in the event that there was a future war and they became necessary. That would give tremendous security guarantees, but we would only offer that kind of tailor-made strategic reserve as a positive leverage point in exchange for tariff-free trade. We want tariff-free access for our aluminum, steel, lumber, and autos. And I think that we should use the leverage we have to get what we want from our American friends.
That was Pierre Poilievre, leader of the official opposition of Canada. For our full conversation, you can always head to our website, bnnbloomberg.ca. Coming up, will Canada be left with a stronger soccer economy after the World Cup? We will take a closer look at that after the break. Canada's monthly job growth in May stands as the largest since November 2025. The country added nearly 88,000 jobs, driven by increases in construction, recreation, transport, and warehousing. In another positive sign, the jobless rate for youth fell by 0.9%. Analysts say Canada's economy is not booming, but it's not falling apart either. Bloomberg is reporting Canada, the U.S., and Mexico will not meet the CUSMA renewal deadline of July 1st. Part of the agreement includes extending the deal for 16 years. If the countries don't agree to renew the deal, CUSMA remains in place until at least 2036 and will enter rolling annual reviews. According to the report, by rejecting the formal review, the Trump administration will trigger negotiations and an indefinite period of uncertainty about the agreement. Broadway just finished its highest grossing season on record, generating $1.9 billion U.S. in ticket sales. Revenue, attendance, and ticket prices all rose over the past year. This comes ahead of Sunday's Tony Awards, where winners are boosted by increased ticket sales. And we're watching the TSX today. It is down. It was earlier today above 35,000 points. Now it's well below that. And you can see it continues to lose steam, down almost 2 percentage points at the moment, dragged down for the most part by the materials index today. We're also watching U.S. markets also in the red. You can see the S&P 500 down almost 2%. The NASDAQ has been down by 3%. It's now down by 2.9%. So continuing to see losses in this index as well. Canada is set to co-host the FIFA World Cup. It's a once-in-a-generation opportunity to boost the business of soccer at home. But when the crowds leave and the hype dies down, will Canada be left with a stronger soccer economy overall? On our special series, I looked into whether there will be a lasting economic impact. Take a look.
1, 2, 3, 4, 5, 6, 7.
Playing professional soccer for a women's league here in Canada is something Nikki Small never thought would happen.
When I went to college, my only goal in life was to go pro, and that was looking like overseas or in the States. Like, I never thought I'd come back to Canada.
Now, she's a midfielder for AFC Toronto, playing in a league that's gearing up for its second official season. a season that will continue even throughout the World Cup.
The Northern Super League is taking full advantage of this. We know this is going to pique interest in the game, a game that is already growing so much in this country, but having that extra attention is really important to growth.
Soccer's popularity is growing rapidly in Canada. Even in its inaugural season, NSL President Christina Litz says the league had the third highest attendance in the world for women's soccer.
Great ratings with our broadcast partners, a group of A-plus list corporate partners that supported us this year.
But could hosting the World Cup in Canada give the sport an added boost? Some believe the event could be a financial turning point for Soccer Canada, with the national governing body marking a turnover after years of deficits and projecting a surplus of more than $6 million.
The standpoint of FIFA World Cup comes down to more commercial partnerships. It comes down to more people participating in the game, and it also provides greater opportunity for, even when they look at broadcast rights, they look at more talent coming into the pipelines.
Laura Walczak says participation for soccer in Canada is up and has been increasing year over year. Canadian Tire Jumpstart Charities has been conducting surveys the last 2 seasons, asking 3,000 children and youth across Canada for their sport preference. The data shows half of Canadian youth are now playing soccer, topping swimming and basketball, and well above hockey. And last season, Canada Soccer registered 758,000 people playing the sport across the country. That's still slightly below pre-pandemic levels, but participation rates continue to climb. Compare that to 2023, when Canada Soccer reported 739,000 players registered.
It's more affordable for people to play soccer. It is becoming more inclusive.
According to Jumpstart, the average yearly spending for families with kids in soccer is just over $1,000. That's more costly than a sport like swimming, for example, but more affordable than hockey, where the average spending in a year for a family was more than $3,000. Soccer's popularity has clearly been moving at a pace faster than some of the supports around it. But now, the sport in Canada is starting to see profit also picking up to meet that demand. At Canada Soccer, the CEO, Kevin Blue, says the association has been adding as many different revenue streams as possible. The main ones are now commercial revenue, which makes up one of the biggest pieces of the pie, player registration fees, operations revenue, which spans from coaching to educational services to clinics, as well as government and public support.
Which this year on a revenue budget that will be just north of 60 million.
But Blue says a bump from a deficit to a surplus this year is less about the World Cup and more to do with revenue from philanthropy, which is apparently catching up to commercial revenue in terms of significance.
Our commercial revenue is healthier. Philanthropy is a relatively new line of business for us that was over $5 million in revenue last year, and we anticipate it continuing to be robust for us as we go forward.
I've worked in philanthropy my whole life, but not knowing exactly what to do on the sports side, I looked to the U.S. to see, just because there's so much successful fundraising there among their sports departments and athletic departments. A lot of it has to do with the pride in sports and the alumni.
Samantha Rogers is the VP of Philanthropy at Canada Soccer.
We often attribute that, we see some sports stars that are signing incredibly large salaries, and then so you think that all athletes have money and that all sports have money, but that's not the case at all. Especially as an NSO, we manage the sport from grassroots all the way up to our national team system. I think people naturally just assume that we generate a lot of revenue, but that's not the case.
She says in September, the association launched its Canada Rising campaign to raise $25 million by the end of 2027. And currently, they're at $17 million pledged.
When we say that we're upwards of 17 million, that's because people are pledging to give over a couple of years with us, which is really great for our sustainability. And when we look at investing in philanthropy, it's really around a very modern and progressive way to be able to diversify your revenue stream and really make sure that your organization is set up sustainably for the future.
Rogers says the money will be focused on Canada Soccer's 3 pillars. $10 million will go toward the national team systems, from youth all the way to senior teams. Another 10 will go toward accessibility, providing soccer in schools, as well as financial grants to help families cover the cost of soccer. And the last $5 million will be dedicated to coaching and refereeing.
We are bullish about the long-term trajectory of soccer in Canada. We're also, of course, cognizant of the cyclical nature of Men's World Cup years.
Canada Soccer recently also received nearly $10 million from the federal government through its Build Communities Strong Fund. That money will support the planning, design, and pre-construction of Canada Soccer's National Training Centre, a permanent, high-performance home for its national teams. Debate continues around the soccer community on where additional funding should go, especially as we're about to undergo a legacy push from the 2026 World Cup. When it comes to the NSL, Litz feels there needs to be some serious upgrades in infrastructure.
In Canada, we have stadiums that are 3,000 or 30 to 50,000. We really need to look at investing in those mid-size stadiums here in this country if we're going to grow this game significantly. Never mind the fact that there's still a lack of training fields and pitches for community involvement.
Small, meanwhile, has started up her own foundation to focus on the grassroots side of things, breaking down barriers for young people to play soccer for little to no cost. But one thing almost everyone can agree on is this year will be one of the most pivotal moments in Canadian soccer history.
We do think there's a lot of tailwinds with soccer.
And Small says she will be watching.
It's just going to bring so much awareness to soccer in Canada and obviously the soccer fans in Canada, and you're just going to see how much Canadians truly love this game.
Still ahead, we'll check in with Bloomberg's Canadian finance reporter Christine Dobby right after this. Bloomberg's Canadian finance reporter Christine Dobby breaks down Canada's economic picture, the U.S. president's latest jabs, and Brookfield's big AI bet. That story is featured in her weekly Bay Street Edition newsletter, which tracks the biggest stories in Canadian finance. And for more, Christine Dobby joins us now live. It's great to have you. So we'll start with the first part of what you're writing about this week, and that is the Canadian economy in the midst of all these trade talks. What's going on there?
Right. So, as we probably all know, last week, Statistics Canada reported that the first quarter of the year GDP did contract, putting Canada into a technical recession. And there's been a lot of back and forth discussion amongst economists about what this means. Pretty much everyone agrees that 2 quarters of consecutive GDP declines do not an actual recession make. There's a lot of nuance to that. But Donald Trump seized on this and tweeted out, Truth Socialed out a link to a Bloomberg story on the technical recession with the comment 51st state. So, of course, that led to a flurry of discussion in Canada. And this all comes right as Dominic LeBlanc, who's in charge of U.S.-Canada trade relations, was heading to the United States to meet with the U.S. trade representative. It all links together because part of the reason Canada's economy is faltering and weak, at least, if not in a recession, is obviously all tied to the trade uncertainty. And that's a theme that we're going to come back to time and time again as this summer goes on.
You were also writing about Brookfield's big bet on AI. Tell us more about that side of things.
That's right. A couple of my colleagues, Leanne Oda and Don Lim, wrote a big feature on Brookfield's really big AI ambitions. They're looking to raise about $50 billion across a number of different funds, all aimed at investing in the infrastructure behind AI. And so this is a story that's well worth reading. They've got a good look at some of the main players within Brookfield who are leading this push.
Okay, we'll leave it there. Bloomberg's Christine Dobby joining us live. Thanks so much for that. And you can always sign up for Christine's weekly newsletter called Bay Street Edition by going to bloomberg.com/newsletters. Thanks, Christine.
Thanks.
Coming up next is Hot Picks. We will zero in on 3 picks in the materials sector. Right after this, stay with us. It's time now for Hot Picks, and today we zeroed in on the materials sector. To tell us his picks, we were joined by Martin Pradier, materials analyst at Veritas Investment.
The most growth I see right now is the copper sector, probably the ones that sector has done better year to date.
Why is that? Because I have noticed the last couple of weeks the price of copper has been rising relatively most days. So what's behind that?
Basically, it's a fear that the U.S. will increase the tariff on copper, and there is now a big price differential between copper in New York versus copper in London. And so the U.S. is attracting all the copper and raising the price for copper worldwide. And it's not, and they basically, the inventory of copper around the world is increasing, especially in the U.S.
Okay, so let's get into your top picks then. Wheaton Precious Metals is your first one. You believe this will outperform other gold stocks. Why is that?
Well, one of the things that's been happening is we had inflation, right? And so my 2 picks for gold that are Wheaton and Franco-Nevada have the advantage that they don't, the cost is relatively fixed. It doesn't go up with inflation. So that's one thing. The other thing on Wheaton is that 40% of the revenue is coming from silver. Silver right now is up 100% compared to silver exactly 1 year ago. That was about $35. While gold is only up 33%. So it has an advantage in terms of year-over-year earnings. It should grow faster. The third thing the other thing about this company is the growth that it has. Nobody has this kind of growth. So for this year, in terms of volume, it should grow 12%. For the next 5 years, it's going to grow 50%. Our best gold miner, that is Agnico, the growth is going to be only 20%. So there is a big differential there.
When it comes to sorry, continue.
Yes. The third thing is the valuation. The valuation is extremely cheap. It's 1 to 2 standard deviation in forward PE and for EV/EBITDA. That's the way I look at the stocks. And that means that it has hardly ever traded at this low valuation in the last 5 years. So it's very, very interesting in that sense.
Okay, and when it comes to Wheaton Precious Metals, any risks or headwinds for this company moving forward that you're watching out for?
No. There isn't anything. I mean, at the end of the day, the price of gold is your risk on all the gold stocks. So it moves with the price of gold. So if the war with Iran finishes tomorrow, I think there will be an increase in the price of all the gold stocks. But that's probably your bigger risk.
All right, Franco-Nevada is your second one. I know you already touched on it, but if you want to go into more detail as to why this is your other hot pick for today.
This stock is almost like a free option. So it's trading, again, 1 or 2 standard deviation in terms of P and EV/EBITDA forward compared to the last 5 years. And it has the potential that their earnings can grow about 20-30% if Cobre Panama restart. So Cobre Panama was a mine that was stopped 3-4 years ago. The government of Panama needs that mine to restart. We believe there is like 70-80% probability that the mine will restart. At the time when they stopped the mine, the stock had like a 30% decrease. So if the mine restarts, which we think is very likely, then you could have a 25-30% upside on that.
Lastly, we were talking about copper prices to start off this segment. Hudbay Minerals is your last top pick. Tell us why.
Well, Hudbay Mineral has a couple of advantages. The first one is 40% of the revenue is coming from gold. And this is the reason why the cost is negative. So the cost, for instance, in the last quarter, the cost of Hudbay Mineral was minus 1.80 per pound. So 180 cents negative. On average, the other 10 companies that I follow, the cost is positive 1.46. So this is a big differential. We believe also that because the company is guiding 20 to 40 cents negative for the year, and the first quarter was so strong, and at the end of the year, the volume is going to increase in two of their mines, that we're going to see a revision of the estimates, which is always a catalyst for a stock. The third thing is the valuations are 30% below the comparables, the 10 companies we follow. The other thing will be the growth. Almost nobody has this kind of growth. So in 2025, this company will produce 118,000 tons of copper. In 2030, they expect to produce 250,000, and in 2032, they could produce 350. So there are two big projects coming in. Both projects are in the U.S., which has a very low risk. Projects are very easy projects, not complex, high IRR. So that is another advantage. And finally, if you think that the U.S. is going to put tariffs, this company is one that benefits the most. Because what ends happening if you have a tariff, if the price of copper in the world is, let's say, 5, and everybody is coming to the U.S. and then let's say it's a 15%, so you get 575. Because the U.S. is an importer of copper, the internal price in the U.S. will be 575, and this company will sell at 575 and having an advantage because it's producing in the U.S. and has no tariff.
That was Martin Pradier, materials analyst at Veritas Investment. Okay, let's take a look at the markets before we wrap up here. It's a bit of a sea of red out there today. You can see the TSX down almost 2% at the moment. S&P 500 also losing a lot of ground. And the NASDAQ down just about 3% today. So we're really seeing a halt to that tech rally that we saw the last couple of days. In particular with the North American markets, we're seeing a bit of a chip sell-off today. Some of the major chip manufacturing stocks are down quite a bit. Qualcomm, one of the big ones, down almost 10% today by this afternoon. Micron Technology, another one that's really bringing the NASDAQ down today, is down almost 10% as well. And Advanced Micro Devices also down by 8.8% at the moment. Also, we are watching Bitcoin. This is another big story. It has dipped below, or it did earlier dip below the 60,000 mark, and we've seen Bitcoin going lower over the last couple of weeks. Originally, it was around 80,000. So seeing quite a drop here, and we're continuing to watch Bitcoin as it kind of scales down every day, it seems, recently. We're also watching the TSX, of course. And as I mentioned, it's losing a lot of ground today. So we saw the TSX close yesterday above 35,000 points. Now it is well below that. It's down by 1.8% this afternoon. And we know that there's a couple of stocks that are actually pulling the TSX down. We know the materials sector is a big one in terms of indexes that is dragging the TSX down today. But if we look at certain companies within the TSX that are in the red, Shopify, one of them, down almost 6% at the moment. Agnico Eagle, another one. Of course, gold prices are down today. Agnico Eagle reflecting that it's down more than 6%. And Celestica is down more than 10% today. So we're going to keep watching all of that for you. Stay tuned to see what else happens throughout the day. Maybe we'll see a bit of a rebound. We'll have to wait and see. Investors also obviously watching the conflict in the Middle East and whether there's any progress on peace deals between the U.S. and Iran, whether the Strait of Hormuz will open soon. It seems as though any form of peace talks has now stalled. And so that's obviously not helping investor confidence today on this Friday. That wraps up this edition of Trading Day. Thanks so much for watching.